Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for November 22nd, 2014. We have a market that's in bullish normal conditions. On an annual basis, using weekly RSI 14, we're at 67 out of 100. On a 10-day basis, using the 10-day NDX, we're at 75 out of 100. So both are in the higher end of normal. Looking at the market mosaic, price relative to the 200-day moving average is at 7.95%. That's white bullish. The slope of the 50 has improved to 0.37. That's bullish. ADX is strong, trending up at 31.0. ATR percentage has declined to 0.63%, so normal, right on the edge of quiet. The risk index is the 30-period moving average of the VIX divided by the 10-period moving average of the VIX. The boundary between risk off and risk on in that ratio is 1.0. The current reading is at 1.17. That is risk on. When we take that reading of 1.17, compare it to the last 5,000 trading days, and find the standard deviation, we define normal as between 1 and -1 on the z-score. We call that the risk z. Current reading is at 2.02. This is a 90-day histogram of that reading, and you can see that we've had declining volatility, and now volatility slowly starting to creep back in as it has rolled over from an extreme of almost 3. So we've seen almost a 6 standard deviation change in the volatility regime. This still favors the long side, but it suggests we're closer towards the end of this last move than the beginning. Blended monthly rebalancing continues to hold these positions until on or about 1 December. These are the current leaders based on market action at the close on Friday. See that it has shifted away from the defensive plays like real estate and treasuries to the broad U.S. large cap markets, which are still the dominant place in the market. Theoretical exposure of ETF2 is 40%. The model portfolio is at 60%. Quick summary of the ETF blended monthly rebalancing portfolios for the 13 and the 32 portfolio. You can see the difference in performance between the U.S. large caps and the globals. It's quite striking. ETF Max looks at 1,300 ETFs around the world and uses this blended monthly rebalancing look back. I like the ones that are green and white. They are earlier in the life cycle of outperformance. So the CMCI Livestock Index, more agriculture livestock comes to mind, as does the U.S. deflationary ETN. Meanwhile, it's biotechs, China, biotechs, India, some retail. This is interesting, the RTH retailer. This is the blended monthly rebalancing lens looking at the S&P 500 components, along with the sector that they are a member of. XLV is dominating this stack, so things like Vertex continue to outperform. Looking at our green and white or green and yellow, we'd be focusing on, we'd be interested in Staples, Lennar Corporation, Macerich, Tractor Supply Company, Bristol Myers Squibb, and Visa. Market health check. The vertical blue lines represent 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that used to be resistance levels and which should continue to provide support going forward. If they fail, then they become price targets on the way back down. You can see that we're at an all-time high, but it closed with a red candle here. You see the slope of the 30 is this black, thin wave-looking line. The blue circles are moments where it achieved a local minimum or maximum, a turning point, or where it crossed the zero line to confirm the change in trend. You can see that we got the slope is way up here at 0.70. This 30-day performance is extraordinary. extraordinarily steep. Anything above 0.4 is really remarkable. We're definitely in the green zone up here. We're going to see just how steep this is in later on. The dark blue shaded area is the river. That's 30-period Bollinger Band plus or minus 1. The floodplain is plus or minus 2. We're well into the floodplain here and have been for 10, 15 days. The dark red shaded area is the boundary is the 200-period moving average and the region below, the bear. Williams percent R has been overbought now for almost 25 days. Percent price oscillator has closed its jaws, suggesting that this run is done. And so now we will now question whether or not this is the next leg up, or whether this was some kind of shooting star doji at the top, signaling a local maximum. But in any case, would be looking for support around 202 to hold for this to remain true. We're definitely in the green zone. I have a bias towards being long on the intraday trade. If it were to fail below 205 and between 205 and 192, I'm interested in simply going in the direction of the daily market move for the intraday trade. It wouldn't be to 192 before I would adopt a short side bias by default. So this is a market that we're going to see what this means here on this short week. I would expect some good tactical trading on low volume, but the U.S. market is looking very strong here. The large caps especially, it's a broad-based strength, and there's no reasonable long-term alternatives in the near future. So it continues to be all U.S. all the time. You can see here all the globals are on cash signals using the ETF2 regional report lens, and all the U.S. symbols are on buy signals. The S&P at 79 is better than the global's EFA at 68, decisively so. Inside the U.S., it's technology at 82, large caps 79, mid caps at 76, and small caps at 75. Two strongest sectors are tech and U.S. large caps, Qs and SPY. The two weakest are Latin America and Asia less Japan. The S&P 9 sectors, everything is well above average with the exception of energy in the red and consumer discretionary in white, but that's a high level of white. World market model, everything U.S. is above average. This is the Dow, that's the NASDAQ, exceptionally strong. Japan below average, Asia list, Japan well below average. India and Thailand, Hong Kong, Taiwan, Philippines above average. In Asia, everything Europe down. Latin America very weak, emerging markets only weak. Brazil very weak, but we had some good trades, some good tactical trades to the upside in Brazil this week at the live trading workshop. I have the U.S. business sectors are dominating their global counterparts across the board, and healthcare continues to lead the way no matter where. The dollar up is still very strong. These are the top 40 or so in the top 30. Using the ETF2 lens, we'd be interested in 3M, Japan total dividend, utilities, this whole stack in the white here. Real strength remains in biotech, healthcare. Looking at the Dow 30, Nike, Visa, United Health, Home Depot, and Intel are the no-brainers that if you see them outperforming the market on an update, you can trade those at a very low risk, as a very low risk idea. 3M and Walmart, Cisco, Coke, and DuPont continue to excel in the green and white, along with Goldman, JP Morgan, and Johnson & Johnson. Only IBM suffering in the red down here. White and yellow, so that's McDonald's and Caterpillar on the move up, as is United Tech. ETF liquidity stance, these are the symbols that are simultaneously the most liquid and also the most volatile in the green. This is based on average 30-day dollar volume. Shifting now to Monday's report. We have some 551W signals, and then auto framer candidates in IBM and Asia less Japan. Latin America and Europe signaling short side trades for the overreaction. I would wait to see evidence of failure before I just bought those. I would modify that swing system rule, but that's where the weakness is. And if you see weakness in those two, then that's something you can pile on. I would put Brazil in that same category as ILF since they are so strongly correlated. Just a couple channeling signals here in the Dow. Disney, Verizon, Microsoft. IBM has a 2.3 on the auto framer. You have Verizon at a 9 on the RSI2 and AT&T at a 9, and both are also good frog candidates. See the real strength down here in Alcoa and Walmart. ETF 30 really just Asia less Japan at 2.1, nothing on the RSI2, and only one frog candidate here in U.S. real estate. The auto framer stats for IBM and Asia less Japan, and the regression line fractal framework for those symbols that are the most ATRs below their own regression line 270. These are the ones that where the short-term traders have pushed the price way down, either creating a value play or a justified shift in long-term orientation. And then these on the bottom stack are the ones that are the most numbers of ATR above their own 270, and so these are going to be your relative strength leaders like Nike and Visa. Visa is one to be taken a look at since that's a newly emerging strength candidate from the BMR lens. And that's everything I want to cover today. Oh, I take that back. Let's take a look at that 30-day slope. So this is the last 30 days. That's what I want to talk about. The steepness up of that, you can see shown down here for the last 30 days in blue. It's more than 2 standard deviations above the last 180-day normal. And this is the 10-period moving average. It's still well above that. But compared to the last 180 days, you can see just how steeply positive that move has been. Quite an extraordinary move. And then I want to show you what that looks like looking at the stats compared to the last 10 years. This is the steepest it has been up in the last 10 years. That's the best 30-day performance in terms of performance in the last 10 years. Remarkable. See just how on a ATR percentage basis, we are hovering just at the edge of quiet here. So quite a remarkable move. And that leads me to be very concerned about the fact that it closed red and a low volume week coming up. I would expect some tactical shenanigans in here. But really, if we take that as the close of a chapter, and if we can still sustain above 205, man, this is another leg up. Should be quite a move. On a 40-day holding basis, you'll see the S&P in terms of just absolute gains, though. All in the white here. So the 20-day move is one full standard deviation above its 20-year or its 10-year historical context. The diamonds have had a really remarkable move, as has XLP. And really only the diamonds and XLP overheating right now. The 5-day holding in Latin America is 2 standard deviations above its 10-year average. So those are some pockets of real strength and outperformance right there. Looking at the RL slopes of the 10, the 30, and the 90, you can see the 10 had been out to a Z plus 3, pulled back to flat, and now starting to hook up. The 30 period up here around 3Z, and the 90 has rolled over and started to move back up. Now the nice thing is that this 90 is giving it still room to run. Another leg up is still certainly feasible, because if you draw this line out here, you see that this very steep 30-day period only brought it back to the normal outperformance up in here along the upper edge of the river. So there's still room to run now that this pause to refresh has taken place. We could definitely see some upward movement here. And that's everything from the weekend report I want to highlight. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.